Hi team. So we just finished having a class Q&A session on Zoom, of which at the beginning I definitely clicked record. However, somewhere in the sharing of screens, I'm not sure how it got unclicked, but it did not complete the recording. So I thought I would do just a quick overview of what we chatted about and then provide you with the handout, so if you want to go over it, you can. So what we covered is we talked about the bad debts expense, bad debt recoveries, and allowance for doubtful accounts. We looked at practice exercise 2 and how it's different from practice exercise 1. And then we also found an error in the answer key for practice exercise 3 and corrected that. So just as a quick run through, for practice exercise 2, the difference between it and practice exercise 1 is you need to break out the different invoices by date issued within each customer account. So instead of having one balance, say $620 owing at one point in time, we actually have to look at the different invoices. So we don't know when this $648 was originally invoiced according to this customer report, but we have a July 31st 2025 date that of the balance forward. And now there were payments made, and I simply took the GL that is provided in the textbook and reorganize the lines a little bit, because 200 plus 48 plus 150 is not more than 648. In fact, it leaves us with a balance still owing of $250. But there's only $250 owing, and it's owing from the same time frame as this 648, which we know is at least July 31st, 2025. So an easy way to do it if you use Excel is to simply put the date that you're working with. So our year end is December 31st. You see that I put it in all three of these lines. And then if you go in Excel and you just put the equal sign and you equal your year end date and you minus the date in play, well, you're given the number of days. That's the difference. And so we can see that there was 153 days from December 31st to July 31st. So that's in the column at the very end of 90 plus days overdue. We have to remember that the days overdue are not the days since the invoice was written, because unless the terms are net zero, due immediately, then they're not overdue until after that net however many days. So in this example, it's net 30 days. So we need to take that into account. So when we have 153 days, well, we want to look at the number of days that apply to that aging period. So 90 plus days overdue means that there is 121 or more days since that invoice date. So that falls in there. And then for this invoice on September 5th, well, that's 117 days. But 117 days is more than 190, but it's not more than 121. It's actually, it's between 91 and 120. So it falls in this 61 to 90 days overdue. And then the last example here is November 1st, which is 60 days since the invoice date, which means it's 1 to 30 days overdue. So it goes into this column. So we did that together for the first customer, and there's 4 customers in practice exercise 2. So you can go ahead and do this step for the 4 customers, identifying the different aging period. That's where it says do the same for the other 3. And then we talked about chapter 12 concepts. So I'm going to put this Excel file into Moodle and you can read it, but just as a run through, You might want to pause this video actually and open the Excel file and see if you can follow along. So we talked about how there's the different classes of accounts that we're using in chapter 12. So we've got asset accounts, and we also have revenue account and an expense account. So the accounts that we're talking about here are allowance for doubtful accounts, being the asset account. It's a contra account to accounts receivable. We have bad debt recovery, which is a revenue account. And we have bad debt expense, that's an expense account. So we went through an example using two different scenarios, but the same example. Okay, so we talked about what the transaction looks like, the general journal transaction, when a company wants to have a balance in their allowance for doubtful accounts. So think of the allowance for doubtful accounts. It's a contra account. It sits on the balance sheet. So if the company has an accounts receivable debit balance of $100,000 of their customers, the sum of all the customers' balances owing to the company is $100,000. The managers say that the amount that they won't be able to collect on is $6,500. So at year end, the accountant does this journal entry to put $6,500 into the allowance for doubtful accounts account. And they have to have a debit to offset that. You can't just throw $6,500 credit into allowance for doubtful accounts. You have to have somewhere to debit. Well, no money came into the bank. It's not going to debit the bank. It gets debit to an expense because essentially it's being eaten up. It's revenue. It's not coming in. And there are tax implications because on that original revenue, tax was charged and is sitting on those customers' accounts. So when they do an allowance for doubtful accounts transaction, there needs to be a debit to bad debt expense and a debit to GST. So you have to break out. So if the manager says $6,500 isn't collectible, well, that $6,500, that refers to whatever the customer paid. So the customer, they're not just paying revenue. The government wants their cut. When the customer was charged, they were charged a revenue amount and they were charged a tax amount. So in our discussion that we went through, we only took GST into account just to go through the motions. So we had to break out GST from the total, and then we debited bad debt expense and we debited GST. And then on December 31st, 2025, we have this journal transaction that takes place, and it makes it so that there's $6,500 credit balance sitting in allowance for doubtful accounts on the balance sheet. So then going forward, they have that room. So now customer John Smith goes bankrupt on February 26th, and the company receives confirmation that his $4,000 bill, total amount owing on account, will not be paid. So the bookkeeper is able to do a transaction that applies a $4,000 credit to John Smith's account to make his account zero, and it debits allowance for doubtful accounts. Now, because on December 31st, 2025, the bad debt expense was already expensed, the GST was already broken out, we don't have to do GST again. So when John Smith made the sale, then at that time he was charged GST. And then on December 31st, 2025, when it had nothing to do with John Smith, it simply had to do with this allowance for doubtful accounts, a bad debt expense was calculated and the GST portion was calculated. But that means the GST's already been calculated on $6,500. It's already been broken out. So when we take from that $6,500, we take $4,000 of it out of the allowance for doubtful accounts. When we apply it as a credit to John Smith, we don't need to do the tax again. Tax is already dealt with. The tax has already been reversed. And then at the end of the day, after this transaction is posted, we're left with a couple new balances. And those balances are in the allowance for doubtful accounts asset account. We now have $2,500 in a credit balance on that account. And the accounts receivable for John Smith, he previously owed $4,000 and now he owes nothing. So we talked about that. That's scenario 1 when a company's using the allowance for doubtful accounts account. And then scenario 2, the same scenario, but let's say our company doesn't use the allowance for doubtful accounts account. So the year end happened and the company had on their balance sheet an accounts receivable debit balance of $100,000 and they had no contra amount calculated. They did not do a general journal entry at year end to write off a portion of predicted uncollectible revenue accounts. They had no journal entry done to that effect. So now, same thing happens. February 15th rolls around, customer John Smith goes bankrupt. You have confirmation that his $4,000 owing on account will not be paid. You can't do this transaction because there is nothing in allowance for doubtful accounts. There's nothing to take. In the initial example here, there was $6,500 credit balance and allowance for doubtful accounts that you could take and apply to John Smith's account, but you can't do that here because there's nothing in that account. So we have to then write it off to bad debt expense at that time, in that moment. So we're going to calculate, we're going to break out the GST on the $4,000 that comes to $190.48. The difference being bad debt expense, $3,809.52. We record that transaction and then voila, our new resulting balances are that John Smith owes nothing. And this $3,809.52 is now showing on the income statement of the company in the current year, the current 2026 year, whereas in this example 1, that bad debt expense shows up on the income statement in 2025 because it was posted on December 31st, 2025. So that's the end of part 1 of this scenario. So where we looked at the first point using an allowance for doubtful accounts, and the second one, there's no allowance for doubtful accounts, so we post it directly to bad debt expense and GST. And then we talked about how a month after John Smith declares bankruptcy, he has a distant relative who passes away and leaves him $1 million. So what happens in that case? Well, his bankruptcy becomes null and void because the trustee goes, oh, you have money now. You can pay your debtors. This bankruptcy is not going to go any further. And so on April 30th, 2026, John Smith comes into the shop and he pays that $4,000 that he had been written off. How do we post that? Well, he comes in with $4,000. So that's the easy one. He comes into the shop. He plops down $4,000 cash. Where is that $4,000 going? Well, the value of that is being received by the company. When the company receives money, it's a debit to the company. Which account is wherever that money is going. So it's going to go into the company's bank account. Therefore, we have a debit to the bank of $4,000. Now, what do we credit? Well, we essentially have to reverse this bad debt expense and GST up here, except for we're not going to credit bad debt expense. We're going to credit bad debt recovery, the revenue account. And then the GST is the same. And that's it. So that's what we talked about in our Zoom meeting tonight. If you have any further questions or you'd like to go over any of these concepts, I am available and happy to help. Have yourselves a great rest of your evening, and I will talk to you soon.